Hey everybody, Marty Mazzora here, Friday the 23rd of February 2023 with your weekly economic update. We will do the usual. I'll talk for a second about our score this week, share a handful of inputs. I want to throw out what I'll call some supplemental data at you via some charts, some commentary, and then we will end with me paraphrasing some of the earnings call commentary these past few days with the help of economist and analyst Peter Bookvar. Before I get started, I just want to continue to make the point that things are really beginning to look up in certain pockets. We're beginning to see some improvement in manufacturing in the U.S. and in other parts of the world, not everywhere. There's pockets of some serious weakness there as well. All the while, we're beginning to see perhaps some slowdown in services, but it's still in expansion mode. And I think I said this last week or earlier this week. Some of these signals are the kinds of signals that we look for as indications that the economy is about to start looking up, that markets are about to start expanding durably, and so on. But typically, these are signals that we get at the bottom of market declines, at the bottom of economic declines, and so on. Often they are early signs that the worst is over in a recession. We live in unusual times. There's no ifs, ands, or buts about it. I described here recently that 2023 was unique because we had actually the combination of massive deficit spending from the federal government here in the U.S., while a great deal of dis-savings on the part of the consumer, meaning the consumer spending down savings, spending lots of money, helping the economy that way. Typically, the federal government doesn't step in very big or doesn't need to, if not actually pulls back, because the consumer at that point is doing the heavy lifting. Conversely, when things are weakening, consumer confidence is down, consumers have spent their savings, they start getting conservative, spending less, start being very selective, and the economy begins to show it. Then the government starts running bigger deficits in order to replace that aggregate demand or fill in the gap that's being left by the consumer. When you get both at the same time, we don't have those countervailing forces helping each other out. You just had both things happening in a year where the vast majority of economists predicted recession. Our recession lamp was lit all year. Bloomberg economists said 100% chance of recession last year. That didn't happen. Now those recession calls are largely gone. There are still a few in that camp. As you know, our recession light is still lit, which doesn't give us any sort of a time prediction, but it just says the risk is too high for comfort. But as the graph shows here, it's been improving of late. This last week, you can't really tell. It's just a little sideways notch. Our score didn't change after dropping a little bit the previous week. But nevertheless, we are seeing pockets of strength. So now we've got to consider, in a world where markets were discounting several rate cuts, that if indeed the economy is beginning to pick back up, aren't going to happen. Now, it doesn't mean that no rate cuts are going to happen. The Fed is pretty much committed to cutting rates this year. The rhetoric of late from them is don't think it's March, maybe further into the year. Why? Because, with this pickup in optimism that we're seeing in certain places, we're also seeing a pickup in inflation, as last week's data showed. And then here we have PCE data coming out this next week, and if it's hot, market could very well struggle with that. So on one of the slides I'm going to show you, or one of the graphs, the heading going into that is that the bond market or the fixed income market is changing what is discounting or what is pricing in, but the stock market is not. So still feeling like the stock market is very heavy. It certainly is showing up on the technical analyses that I've been showing you. Nothing's changed there. So I'll just keep moving here. Again, the index didn't move this week. 21% of our 47 inputs are positive, 41% are negative, 38% remain neutral. Some of that optimism is showing up in global PMIs. Here is JP Morgan's Global Purchasing Managers Index, where they aggregate a bunch. It went from 51 to 51.8. Anything above 50 is expansion, right? So sentiment indication is that the economy is growing, not contracting. The U.S. Index of Leading Economic Indicators came out. We have this ratio of leading to coincident indicators that has been a very good economic indicator for us historically. It's never been at these levels without being in recession or in close proximity, either going into or coming out. Notice a little bit of improvement here. And that's what you look for. You look for things changing, things bottoming. The green one is the LEI, leading. The purple one is the coincident indicator. It actually ticked down a little bit here this last month. But you're looking for that, right? You're looking for improvement. You don't want to wait till it's roaring again. You want to be essentially a buyer, I would say, although, of course, I'm not making recommendations to any viewers right here. And then clients, of course, we do it for you. But so we're looking for stuff like that. You can see them now. You can see it completely bottoming out here in 2008, the early 2000s recession, right in here in the second recession of the early 80s. That's what the Fed is trying to avoid. I talk a lot about this in client meetings. They raised interest rates in the late 70s, early 80s. They got a recession. The Fed panicked, cut aggressively too soon. This Fed says they don't want to do that. And then inflation came roaring back. They had to raise rates, and they created a much deeper recession. Early 70s, similar scenario back there. You see relatively close proximity of these two recessions right here. So the Fed has said over and over again, and that's, we don't want that scenario. So we don't necessarily want to aggressively cut right now or begin cutting too soon, because inflation comes back, we have a problem. And I've been saying over and over again, right now our base case is relatively mild recession later this year or early next year. But if this happens, if the Fed cuts too soon and inflation comes roaring back and then they have to aggressively hike, I think it will be a much worse recession than what we're thinking is going to occur, if indeed one is going to occur, say again, late this year, early next year. So something to keep our eye on. The U.S. Economic Surprise Index is illustrating what I'm talking about. The economy has been chugging along better than what economists had previously forecast, and that's pretty much the case throughout most of the world. The Eurozone, right up there with the U.S. at 42, Japan at 50, China is now positive. It's showing up better than economists expected. The emerging market complex in the aggregate, though, is still a little less than zero. They were more optimistic than the data has been coming in. But the overall global economic surprise index is a positive 16. Remember, folks, I've been showing you lately a bullish technical chart for copper, right? So we had these bullish divergences, and that's what's playing out. Copper saw a very nice pop here recently, back above the 50-day moving average. And again, I just showed you that China's economy is beginning to look a little bit better. They're certainly incrementally throwing more stimulus at it, specifically at their markets, trying to improve consumer sentiment. And there is a positive correlation between activity in China and copper. From a knee-jerk perspective, it makes sense when you consider how much China historically has spent on infrastructure. But there is going to be some infrastructure spending here in the West this year too. And copper is ubiquitous across all infrastructure, traditional, renewable energy, etc. Now, the Baltic Dry Index is popping here. Cost of shipping across the world's oceans, you can see that's going up. So now when we talk about this newfound optimism in the economy, well, again, with what we think is a very structural inflationary backdrop for a long time going forward, that's what the Fed has to worry about, right? They start getting too friendly with financial markets, and you're going to see inflation come back. Frankly, I think the Fed panicked after that big drawdown from July to October. If anybody tells you they don't pay attention to the stock market, they are delusional, and that goes for the financial powers that be in government or associated with government. They are very, very attuned and concerned about the stock market. And when it was looking scary, the economy reacts as animal spirits are dampened and you get a slowdown. I think the Fed kind of freaked out, and they started talking very favorably about the prospects for easing monetary policy in 2024. Well, now the market's heated back up, and so has inflation to some extent, not hugely, but enough to get them nervous. And now they're starting to walk that back. And because inflation is a serious problem for the Fed and for Washington, quite frankly. It's not something that is politically tenable right here. On the not so rosy side of the data, you can see mortgage purchase applications. This is the fourth week in a row that they've dropped, and that's by 10% week over week. Of course, mortgage rates with this optimism and fear of higher inflation have ramped back up a bit, so that makes sense. Also not so rosy was the Chicago Fed National Activity Index. It dropped to a -30. Now it is an index that is a component of our index. They have 85 data points, and this last month 26 were positive and 59 were negative. So that's going in the wrong direction if you're thinking the economy's heating up. So talk about your mixed signals. Also, truck tonnage just really rolled over hard last month, but again, a lot of weather in January, so I don't know that I would take this one to the bank just yet. So we could see that go in the other direction, but it is what it is. It is showing that trucking activity rolled over in January. And we got a little bit of a pop here in consumer staples performance in the equity markets over consumer discretionary. Pretty good economic indicator. At least it tells you what the equity market is thinking. Now you can see that ramped up big time in January. I mean, it had an outperformance of 6%. And this is one of our top sector weightings, by the way, in our core portfolio. 6% better than discretionary. And then that kind of fell off a cliff here. Still outperformance, but just by less than 1% 10 days ago or so. And here we are moving in that direction again. On balance, that's a weak economy signal. So again, folks, very, very mixed results. You're gonna hear that in a second when I get to some of these company commentaries as well. And then just a few random things that I copied and pasted here for my own purposes. Use some on the blog, but I can share some of this with you right here. So more of that optimism that's showing up in some of the indicators. S&P Global U.S. Manufacturing PMI, it moved up to 51.5 into expansion territory. New orders in that index spiked up here, as you can see. Hiring plans picked up as well. All the while, services rate of growth, rate of expansion still expanding, but expanding at a slower clip. Jason Gephardt made this interesting point yesterday. Unusual situation developing. The NASDAQ composite is up nearly 3% with fewer than 55 issues advancing. Remember yesterday I showed you how bad breadth was. That's what he's pointing out. All 5 precedents, according to Sentiment Trader, where we had this happen, occurred between 1999 and 2001. And folks, that is not a period that you want to see as your analog. Okay, so rates markets, I said this already, have been pricing out some of the Fed rate cut expectations, but not the stock market. That's what that chart says. Stocks tend to rally further after Fed's first rate cuts. I've shown you that before, and I've also shown you that except in a recession scenario. We would be big buyers of a rate cut if our recession light was not lit. A second inflation wave in the U.S. could be problematic. I showed you those 2 recessions. In this one, using JP Morgan and Bloomberg data. The first wave of inflation, and you can see what the S&P 500 did in response. The Federal Reserve at the time reacted to that and so forth. Then we got another big wave, and you can see what the market did in response to that. That's what they're trying to avoid. We had similar phenomenon in the early 80s. And then more on sentiment. Goldman's Risk Appetite Index hasn't seen it this high since 2021, right before 2022, where the NASDAQ went down over 30%, the S&P down 27%. So folks, there's good and bad. So note that I'm not just some screaming mad bear. I'm showing you good stuff. I'm showing you improvements in many, many places, like I did in the first part of my own slide deck, and then what I'm sharing with you here as well. Okay, so let me just try to finish up here, and I'm just going to quickly paraphrase on some earnings calls. Walmart highlights include higher transaction counts and unit volumes, gains in market share in the U.S. and internationally, improved in-stock levels with inventory being in great shape and down versus last year. Strong performance in Walmart U.S. customer experience scores even higher volume the days before Christmas. ZipRecruiter, I think the important thing to understand is that over the last few weeks, we have seen early signs of the labor market flattening out. So effectively, we're in a wait-and-see position, and we remain nimble. And we will adapt to the realities of the market as it evolves this year. But certainly, the flattening we're seeing is something of a new phenomenon given the last 18 months of performance. Live Nation, this is going to be a great year. We're pacing ahead on our arena and our amphitheater business, which is the higher margin business as we've talked about. So we're going to have a fabulous year. We're going to be able to monetize that around the world. When we actually look at fiscal 25, it's going to be a monster stadium year. Fascinating. That is unbridled optimism. Royal Caribbean, since our last earnings call, robust demand for our vacation experiences has significantly exceeded our initial expectations. Toll Brothers, the home builder, since the start of the spring selling season in mid-January, we have seen a meaningful uptick in demand that has continued through this past weekend. So those are some really, particularly Live Nation, those are some optimistic outlooks. So, okay, not all of what ZipRecruiter had to say was positive. In 23, demand for recruiting services dropped throughout the year for companies of all sizes. This culminated in Q4 of 23, which had the lowest Bureau of Labor Statistics reported hiring since 2014, excluding the onset of the pandemic. Obviously, not all roses in the employment space. Bookings, holdings. Now think of this, when you think about Royal Caribbean and so on. And I think it was Expedia last time that I shared with you. We expect the ongoing war in the Middle East to have a negative 1% impact on Q1 room night growth. We're also comparing with a strong start to the year in 2023 when we started to see an expansion of the booking window. Home Depot, very important. After 3 years of exceptional growth for our business, 2023 was a year of moderation. We did have some unfavorable impacts from weather in January and core commodity deflation. We saw a continuation of a trend that we've been observing throughout the year with softness in certain big-ticket discretionary type purchases. Our customers continue to take on smaller products while deferring some larger products. They go on, but you get the gist. Etsy, overall, headwinds continued, including pressure on consumer discretionary product spending, softness in the home and living category, and highly competitive retail environment focused on deep discounting. They say more as well. Wayfair, our category broadly remains under pressure. Camping World, I got to be honest, I'm glad 23 is over. We still believe that the general macro environment is tough. Interest rates are still high, and we're not going to prognosticate on how many interest rate cuts there will be. We're probably, in our mind, thinking that there may be 2, and they're later in the year. So there's still some headwind that we may have to work through. Analog devices, as we previously discussed, the inventory rationalization of our customers that began during the middle of 23 is expected to continue through our second quarter. Encouragingly, first quarter bookings improved sequentially, growing our confidence that inventory-related headwinds will largely subside this quarter. That said, the macro situation remains challenging, and the shape and timing of a second half recovery will be governed by underlying demand. They go on for more as well. Palo Alto Networks got crushed this week from their call. The part that is new, despite the many demand drivers we're seeing, we're beginning to notice customers are facing spending fatigue in cybersecurity. This is new, as adding incremental point products is not necessarily driving a better security outcome for them. They go on as well. So folks, again, very, very mixed signals. If you want to be bullish, just focus on that positive commentary that I read to you. If you want to be bearish, focus on the negatives I just read to you. I just read a very interesting, perhaps telling article in the Financial Times about NVIDIA. I don't have time to keep going all day here, so we won't get into that. But some positive and some negatives, and the potential negatives as we look forward are there. I'm not discouraging anybody who wants to jump onto that bandwagon. Like I said yesterday or the day before, these bubbles can go for a long time. If indeed it's even a bubble, you could argue that based on next year's projected earnings, maybe NVIDIA isn't so far out over its skis. Question is, are they going to hit those earnings next year? If they don't, that's a problem for sure. So again, I said, if you want to be bulls, read the positive. If you want to be bears, read the negative. Folks, I promise you, we do not want to be either. We want to be accurate in our assessment of the risk-reward environment out there. and allocate on behalf of our clients accordingly. Folks, I just should remind you, and this is in the disclaimer, some of you who just watch these videos who aren't clients, I am not under any circumstances making investment recommendations on these videos. This is really focused at clients, but there is some public access to it. So I need to always remind people that this is just me talking about what we're seeing. We do a lot of deep work, both fundamental and technical. I like clients to be constantly aware of what we're thinking and why. And for those of you who have access to this, I encourage you, if you see something here that is interesting and has you thinking about markets or a security in a certain way, get with your own advisor and explore the prospects with him or her. Do not use this as a platform to make your decisions on. And I will leave it on that note. Folks, thank you as always for watching and listening. Talk at you soon. Bye-bye.